always one tweet away. We're hostage to a news cycle that never quits. Money never sleeps, and that's the task that we have. And we're in the middle of a trade war. And trade wars have consequences. There's a cost to war. You and I can debate, the tactics being used to fight this and wage this war, but I don't think what's up for debate is the fact that we have to do this. And that actually resonates on both sides of the political aisle. Both sides want to be tough on China because we want to get to the heart of this.
Do you think that the markets in the U.S., let's set the world aside. Do you think that the markets in the U.S., investors in the U.S., have the ability, the gut, the fortitude to weather this kind of thing out, knowing that there has to be a deal that gets done to put China and the U.S. more on equal footing for trade? We
seem to have the resolve until it starts to hit our personal pocketbook, and that's really the crux of it. Obviously, the farmers have taken the brunt of this, and I think that's why the president wants to get at least a phase one deal done, because that means a $40 to $50 billion ag buy for him helps shore up his base. But the devil's in the details on this, and I don't think anybody really expects, a comprehensive deal that's going to deal with all the issues we talked about.
Let's take President Trump at his word. His words were, "I don't feel pressured to make a deal. I don't feel as though maybe it's better for us to wait until after the 2020 elections to do this."
He's right about that.
Let's pretend that, let's say hypothetically that's all true, all right? How does the market then play out in 2020 if we are not involved in getting a real deal done until the 2020
election? It really depends on where interest rates are. A significant part of the rally this year has been on the base of where interest rates are. The first part of securities analysis is the risk-free rate. If that remains low, then stocks are still the better asset class. But if they start to rise, if we go to anywhere like we were last year or a year ago, we were at 3%, you couldn't get out of stocks.
But the Fed has made it very clear that that's not the case right now.
They can control the short end of the curve, but can they control the long end of the curve? That's the question.
But the long end of the curve has seemed stubbornly stable right now.
We're okay. Right now we're okay. But above 3%, asset allocators like insurance companies, pension plans, traditional fixed income buyers, they start to de-risk and pull their money out of the market. So right now I'm okay. Asset classes compete for your dollars just like everything else. And right now, bond yields are just uncompetitive. Stocks are the way to play it.
We've just got a few moments left here. Yeah. Is this going to be a holiday cheer shopping season for investors and shoppers alike?
I hope so. And it depends on the jobs numbers. We had a negative print yesterday from ADP. That's very important that jobs hold up and consumer spending holds up. That's the base of this economy right now.